This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as he is every week, it is the magnanimous Rob Reinhold.
Boy, last time you said effervescent, now magnanimous. I've got to be looking these words up. You and your fancy college words. No, it's good to be here. Yeah, let's jump into it.
Rest assured, I rarely know the definitions either. But for everybody out there, in episode 51, the last one we did, we spoke about when to pull your money out of your account, when we think it would be appropriate to do so. So in episode 52, we're going to focus on two things. One, more so the why. Why would you take it out of your account? And then once you've done that, where's the best place to put that money? Should you put it anywhere? So we'll answer all of those things today. And before we do that, Rob has a really interesting strategy he told me about that would actually have fit better in last week's episode, but it still really bears talking about. I don't want people to go without this type of knowledge. So we're going to go ahead and lead off with that, and then we'll kind of roll right into everything else we're talking about today. So Rob, go ahead, tell everybody what this strategy of yours is, because I found it really, really interesting and actually really useful.
Thanks, Patrick. And I am bummed I did not think about this until this episode, but look, it's going to be just fine. As an early young trader, I was undisciplined, but I was good. I was good at what I did, but, 1 out of 10 times I would let things slide and let things go. And I was trading in a directional manner. So, when you're trading very directionally and you have a lot of capital on the line, when you get it right, you really get it right. And so I would have these big runs in my account. And, at the time I thought, oh my gosh, Rob, you are so smart. You are killing it. You've been right on 8 out of your last 11 trades. You are a genius. You're going to keep this win-loss percentage up your rest of your career. My delusions of grandeur, we've talked about that. That being the red flag. When you start to have delusions of grandeur in your trading, you are right around the corner from a statistical probability that you are likely going to underperform at some point. And so, I rode these waves in my account value. And one of the things you need to understand is the math is working against you. We have a whole series at Maverick that we call the negative mathematics of leverage. And we go through this point very clearly with all of our traders. If you make one trade, and let's say you make 10%, understand that if you lose 10% on the next trade, you actually lost 11% of your value, over your starting value. Now, hopefully you guys can understand that because your second trade was larger in size because you had a gain on the first trade. So if you are doing a percentage of your account value, your second trade after a win will be larger than the first trade. So if you have all the same percentages, you're not going to lose. Again, if you made $100 on your gain, when you do the next trade, you're probably going to risk $110. If you lose that trade, you aren't back to break even. You are actually down. So you were 50-50, 1-to-1, but because of math, the negative mathematics of leverage, you actually are a little bit of a loss. Now, that's just one trade. Imagine that you had a streak. So let's say that you had 5 wins in a row and then 5 losses in a row. And each time you're making a trade, it's getting exponentially bigger because your account value is growing. So when you take a look at trades 1, 2, 3, 4, and 5, 5 is going to be the largest of the trades. Trade number 6 is going to be substantially larger than trade number 1. And if you take a loss on trade number 6, it's going to wipe out all the gain in trade number 5 and some of the gain in trade number 4. And if you have another loss, it's going to knock more out. Hopefully everyone can see that the mathematics is working against you. And so this is one thing you really just have to think about when we talk about these streaks. it's not that big of a deal if you have a gain, a loss, a gain, two gains, one loss, two losses. The mathematics don't hurt you all that much. It's when you have these streaks. Now, I didn't know this back in the day when I was trading, but I did know that when I had my streaks, when I got cold, the drawdowns were horrific. And I looked at these and I thought, what can I do? Now, I didn't want to stop trading, and because at the time I was, again, on cloud nine, delusions of grandeur, but I recognized that, hey, I'm giving away all my gains when I go into just a small drawdown. How do I fix this? So I started taking withdrawals out after streaks. Now, by doing so, I automatically reduce the position size on the next trade. If I go all the way back to where I was on trade number one, so let's say I have 5 winners in a row. And remember, that fifth trade is much larger than the first trade. After those 5 trades, let's say that I take out all of my gains and I reset to where I was at the first trade. And let's say I lose 5 trades in a row. Now, again, my first trade is going to be the same loss as, my sixth trade is going to be the same loss as my first trade. But my 7th trade and 8th trade are actually going to be smaller. They're going to be smaller because my account is now below where I started. And when I have a drawdown of 5 trades, I'm still going to be profitable. So just think about it. Someone who manages withdrawals and deposits, you can be a 50-50 trader and a 1-to-1 risk-reward ratio. And if you manage withdrawals and deposits, you can actually add an edge. And so what I would do is I would take that money out and I would just stash it, fully knowing that if I have a drawdown, I'm going to put it back in. So sure enough, I would have that statistically guaranteed drawdown. I'd have that drawdown. And again, I made sure that I wasn't the cause of the drawdown. I made sure that I wasn't being an idiot. It was just statistics. I would take that money and put it back in. Now, the next trades I make are going to be significantly larger in size. And if my up streak starts again, I've just managed to add in a little bit of an edge. This is something that really saved me in the beginning because I wasn't disciplined enough to just lay off. After I had 5 wins in a row, oh man, my adrenaline was coursing. I thought I was the king of the world. But I made the rule where I just swept that money out of the account. I could still keep trading exactly how I was trading. And again, I usually went into a statistically guaranteed drawdown after a statistically above average run. I was able to make money, even though I was having those drawdowns. And I told you, Patrick, earlier, I wish I had the math about how much this actually helped me and saved me. But I do know this. If I hadn't been doing this for the first couple of years when I wasn't disciplined enough to handle, these big runs, I don't know if I would be here today. That's how important it was to me.
Yeah, people have to understand things like what we're talking about, what Rob just spoke about, and what we're about to talk about today are so much more impactful to your bottom line and your overall success and well-being than trying to find the perfect entry indicator. By multiples. People just don't pay attention to it. So if you're here with us, congratulations. Now, I just want to touch on that real quick, Rob, because what I was thinking, it's so interesting. And there's no way to measure this in trading. But we all know it's true. Now, you can tell the difference between a new trader and an experienced trader because after a really nice run, let's say 5 or 6 wins in a row, the new trader is going to think they're the king of the world. To where the experienced trader is going to be like, oh, crap, Shitsville is right around the corner at this point. The more I win, the bigger it's probably going to be. Because it's true. Now, let's take something like in the casino, like craps, for example. The closest thing you can probably bet to a 50% win rate is going to be the pass line in craps. Now, let's say you go there and you hit 6 in a row. Do you know what your odds of winning again are in that situation, Rob?
Well, this is a a trick question, and it's you're not asking it as a trick question.
Well, not really, but it's the casino would have you think there's a hot table, or it's your lucky day or something like that. Whatever they can do to get more suckers to the table, they will take advantage of, because your probability of winning the next roll or series of rolls is still 50%.
It's the same.
It didn't change. However, after you fire off 5 or 6 wins with your trading system, for some reason, I feel like the probability of losing is much higher and becomes even higher the more you win after that.
Well, Patrick, let me see if I remember. We did a Maverick Trading Summit years ago in Vegas, and we really focused on the game of blackjack. And we went through all the odds, and we talked about playing perfect basic strategy. Perfect basic strategy is where you don't ever think about what you're going to do. The mathematics dictates what you're going to do. If you play perfect basic strategy, you can get to like 49.6%. And that's where the odds are every single time you play a hand of blackjack. And whether you won or lost last round, it's still the same odds the next round. If you won 7 hands in a row, guess what? The odds on your 8th hand are the same as your first. So that's where I was going with this, was that, okay, it's the same odds. But if you were to place a bet on what are your odds of having 7 winning hands in a row in blackjack, it is 1 out of 187. So again, it's a weird thing. The bet is the same bet on hand number 8 as it was on hand number 1. But if you were betting on what are your odds of having 8 winning blackjack hands in a row, it's 1 out of 187 times. So if you take a look at it singularly, it's one thing. If you take a look at it as a streak, it's another thing. So it's not. That's why I said it's not a clear answer as far as the odds.
Was this at the summit that I was at, the one at the Trump Tower, or was it after?
I think this was after.
Okay, because I don't remember that. But that, yeah, things like that are just really fascinating to me. So I guess the moral of the story is it makes all the sense in the world to bank some profit after a big run like that. I never put that logic together. It could have been impactful to me too. It could have accelerated my growth curve. Who knows? But either way, let's. It's been about 13 minutes. It's probably time to get to the rest of the show here. So let's go ahead and do that now. So we said we're going to talk about the why and the where this episode. Let's go ahead and start with the why. Because even though if it might not appear that way at first, there are a lot of psychological ties to what we're talking about today. But Rob, this was something that you actually added to the outline towards the end. So why don't you kind of lead off with this, and I'll jump in because the rest of it was mostly my writing.
Let's talk about why are you going to take money out of your account. Now look, there's going to be basically 3 reasons. 3 reasons. One is out of fear, one is out of greed, and the other is because it was pre-planned. Now, we're doing a trading psychology podcast, and I think everyone can see A was wrong out of fear, B was wrong out of greed. That was also not the right answer. C is correct, pre-planned. Everything is pre-planned. But the way it works is that there are going to be times where, like for me, I took money out, not because it was planned, but I took it out because of fear of myself. Fear of myself, and I knew I wasn't able to handle it at the moment. That isn't the optimal reason to do this, but if that's the only thing you can do to save your account and to help yourself as a trader, then again, just put some rules around it. Just make sure you put some rules around it. So again, it's not the right decision to take money out of fear. It's not good to do really anything out of fear. But if this is what you need in order to get you over a psychological problem until you can figure it out, then maybe that's what you need to do. For me, again, I don't have this issue anymore of where I was an idiot. I do this much less often than I used to do as far as making withdrawals and deposits, much less often. Now it's very, very systematic quarterly, end of year, stuff like that.
So I want to add to that real quick, Rob. I will say that as far as the reasons why, if that reason why is out of necessity, then I think you're doing this wrong. Now, I don't want to go too deep into this because we might be foreshadowing into a future episode, possibly next week's episode. But if you're taking it out to pay bills, for example, then might have not been the greatest idea to start this in the first place. And we'll talk about that more later. I just wanted to add that part in since we're talking about the why, and since it's kind of such a short piece of all this. That's the one thing before we even get there. I mean, if it's some emergency or something unforeseen, that's fine. But if you're taking it out just to get by, I don't see that as very sustainable. And I just wanted to add that part in.
I think that's very important. And in last episode, I shared a way for you to go in and see what that actually costs you. You say, oh, I need $500 to fix my car. When you go into the actuary tables and see if I take out $500 out of my account, how much is this going to reduce my growth over time? That $500 could be $5,000 over time. So I'm 100% with you, 100% with you. And we talked about this last episode. If you're going to take it out, you got to pay it back. You're robbing from yourself. You're robbing from your future. We get it. There's needs sometimes. Take it out. Just make sure it goes back. I also want to talk about, again, taking money out for greed. So we all got into trading for the reason of we wanted more money. Now look, more money is great. It brings stuff like security, peace of mind. You can do the things you want to do. If you love to travel, you can travel. If you like to do other things, you can do that. It gives you the ability to do that. And we all get into trading because we want to have the money to live the lives that we want. However, I want you to take the same attitude when you are looking to take money out of your account and you're saying, hey, you know what? I want to take money out of this account. I've had a good year and I want to buy me a new stereo for $2,000. I want you to go into those actuary tables or the retirement calculator, and I want you to see what that is actually costing you when you look at it. When you take $2,000 out of your account and you no longer get the compound growth on that $2,000, that stereo may not be all that valuable to you anymore. Looking at it this way is the right way to look at it. You are robbing from your future to buy this stereo. Now look, I've got no problem if you buy a stereo, but I think that should be done with the money you earn at your job. However, I also think you should put that money in your trading account and forego the stereo. But look, I am not a cold-hearted machine here. You do have to treat yourself, but everything needs to be very, very thoughtful and see, okay, is this something I really, really want? Treat yourself, but I want you to take a look at every time you take money out, what is it actually costing you in the end?
Cold-hearted robot checking in here, and I would say one thing to that, like, if you have your eyes set on a $2,000 stereo because that's you treating yourself, maybe treat yourself for something less. A good bottle of champagne can go for $100, $200. Maybe just treat yourself that way. I use the, I don't know if it's an anecdote or what it is in my videos, saying, in this world, you never really get to drink the full bottle of champagne, and you're still not really doing that. The game is hardly won, but it's okay to celebrate and treat yourself sometimes after a really good run. You took the risk, you put in all this work, and and it is paying off. Long term, we don't know yet, but it did now. So a small portion of that to treat yourself, I think I'm okay with. But like Rob said, yeah, you got to really see the cost of buying an actual thing. And that retirement calculator is great. We'll go ahead and link it down to the bottom of the show notes on this episode as well, because this is something that so many people who come into any kind of money for the first time never consider, and it just ends up putting them even further behind, which leads me to, in my opinion, and I want to see, Rob, where you have this on your scale, the very first place I would put money that I take out of my account, especially early on in the first few years, is I would immediately start to pay down debt. Now, that is the most unsexy place you could ever put it. But if you understand how money works, and most of you here do, more than your average person, you know, and I've said this before, we talk about the miracle of compound interest and how it can work for you. But if it is working against you, which is what debt is, because there's almost always interest on that debt, then it can be one of the most horrendous things to ever happen to you. You just have to decide which side of that scale you're on. And if you're on the wrong side, the sooner you get off of it, not only does this help you monetarily, and this is somebody who's been on both sides, I am currently debt-free, the peace of mind it gives you and what it just enables you to do monetarily and psychologically, I don't even think you can put a price on. So this, for me, Rob, is an easy number one, top of the list. Do you feel the same way, or would you have it a bit lower?
I will never, ever, 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 ever again go into debt in my life. I'm telling you, I will sell my house. I'll sell my house. I'll sell my cars. I'll sell everything. I will not ever go into debt again. That's how strongly I feel about it.
Okay, good. Yeah, because I'm like, well, I don't really have any assets, but I would sell crypto and stocks just to get out of debt if I were to get in it. But I have the same outlook that I've had for a long time. If I can't pay cash for it, then guess who doesn't get to have it? Me. And that goes for everything. So I may never buy a house, but I'm okay with that. I would rather not own things like that and go into debt than to live the way I live right now. I'm telling you, it's so great you cannot put a price on it. Anything else you want to add to that, Rob, before we move on?
I absolutely do have something to add to that. I have yet to find any material thing in this world that I can buy with money that gives me more satisfaction than looking at my account value. That, to me, is the greatest thing in the world. And I know, my wife is like, hey, let's go spend some of this. And I'm like, no, that number will go down. And if that number goes down, I won't be as happy. And that's a ridiculous thing to think and a ridiculous thing to say, but it is how I'm wired. So for me, that is peace of mind. There's nothing that money can buy that gives me a better feeling than having freedom, having peace of mind, knowing that the shit could hit the fan and I'm going to be fine. I don't want stuff. I want that.
Yeah, and it's funny, as different as you and I are in a lot of ways, that's exactly how I feel too. I cannot think of one thing that I could spend, maybe a really fantastic bottle of whiskey or wine or something like that, but even still, it's like I would rather just kind of have the money, because psychologically there's such a comfort and pleasure of just knowing that if you ever needed it, it's there. And I always, when I was coming up, with hardly any money, I never wanted actual things. I just wanted to be able to have these investments that other people got to have. I'm like, why can't I do this too? This is in my mind, I was like, this is so unfair. So yeah, now that I actually have those things, that's number one for me too. But I guess while we're on this subject, but before we move on to other places that this money could go, maybe I had this in a bad place, but still, I wrote down that now, if you're ever thinking about it, when it comes to things like crypto and gold and stocks and things like that, now is really not the time to speculate on very speculative things. Maybe that was always your dream, to be like, oh, I want to get into these meme coins, or I want to get into these really low cap penny stocks, or these other speculative real estate investments, things like that. I don't think this is the time, Rob. I think the time for that is much, much later, because you're taking a risk, and it's not even a very probable risk. And just the idea of actually making money in trading and being able to take it out and use it, which is such a rare thing, only to lose it on a speculative investment, I could never put myself in that position. That would just devastate me. What are your thoughts on this?
My thoughts are, again, just think about your life. You have your assets. Your assets are money that you already earned and saved up. So those are your assets. I would never advise anyone to take your assets and put it into something very speculative. But I would absolutely encourage someone, especially if they were younger, to take some of their extra money they earn from work and put it into a speculative asset. Don't take your good money, and again, I'll just call it the assets, the good money, and put it into Dogecoin. Don't do it. Like, don't say, hey, I've got this 500 shares of Microsoft stock over here that I've held for years and it's done great for me. Let me sell that and put it into Dogecoin. No. That's good money. If you want to take your extra couple $100 that you have at the end of this month and put it into Dogecoin, knock yourself out. But your assets need to be guarded and protected. You can swing for the fence, but just do it on money that you earn and you don't need.
Yeah, so to kind of wrap that one up, the two places we really would not put it in is a depreciating asset or something highly speculative. Throwing good money after bad, I suppose, would be the quote there. So, all right, well, we know where not to put it. We know a really great place to put it in terms of taking down your debt. So where else should we put it? Let's say your debt's paid off. Let's say you want to put some towards debt and some somewhere else. Where are the best places to do that? Now, Rob, I want to start with the main one you came up with here. Now, we have do-gooder St. Robert. What would you do with the money? What's the first place you would go with this? You completely caught me off guard with this, but it makes so much sense when you say it.
All right. The first thing I do when I have a good gain, the first thing I do is I give some money away. I either will find an organization I like, or I'll literally just go to the bank and get a couple $100 and go to a store or go downtown and find someone that I think could use it, And I don't know how I make that determination. I guess it varies every day, but I give some of the money away. Now, here's the irony, Patrick. I also do this when I have a bad streak, when I'm worried about money, when I say, oh my gosh, money's tight, or I'm a little bit worried about it, or I've had a down move. I go and get some of my money and give it away. Whenever I'm down, I give money away. Here's the reason why I do that. When you are struggling and money is tight, you get into this mode where you're clutching what you have left. You're clutching every penny and you're watching every single dime and nickel, and you're in this mode of fear. And that is a really difficult state of mind to make money at. It's very difficult. People that are poor, they're not going out and taking advantage of new opportunities. No, they're clutching what they have and just struggling. So I don't want to get into that mindset. So the way for me to break out of that mindset is to just give some money away. And it's money that I don't think I can give away. And what happens is it totally resets my brain that, you know what? You don't need this money today because you'll make more money over the next couple weeks. And that completely programs my brain that money's coming. Now look, I still have to work. I still have to work my ass off. I still have to do all the things that are going to make that money come in the future. But I'm programming my brain that, hey, there's plenty more on its way. It's not working right now. Yeah, you're stressed. You shouldn't give this money away, but you do anyway. One of the biggest reasons I fell in love with my wife was that she was living on her own. And she would have like $20 left and wouldn't get a paycheck for another week. And she would go buy a $20 gift for her niece or nephew. And I remember looking at her saying, wait, that's the last $20 you have. You literally can't spend this. You need to eat. And she's like, I'll figure it out. And you know what? She always figured it out. Give money away. I'm telling you, it's the weirdest thing. And I'm not telling you to be a saint. This is selfish. Understand, I'm doing this for me. Yes, I like to help other people, but my primary mission is me. I'm doing this so I can get my mindset correct. I know I should admit that. I should be like, I'm a great person, but no, I'm doing it for me.
No, I mean, I think the reason most people donate money. There's some type of selfish angle to it, whether it just flat out makes you feel better. That's a selfish wish too. Or whether it's for tax reasons, whatever it is. But I think the majority of us always dreamed as well of getting to a point to where we could easily give back. So I don't think that's too strange at all. Oddly enough, I was with kiva.org for a while. I'm always, I like to help people who help themselves. And so it would be like little small business loans, interest free, and they would just pay you back, which was great. And then they changed some of their policies, so I haven't done that in a few years. But I need to get back on that for sure. That was great for me. And I didn't even have to pay attention to it or keep track of it. It just ran itself. And everybody except for one person paid me back, and that one person who didn't paid me like halfway back. So it was really crazy, really good.
Hey, Patrick, I want to jump in here and issue a challenge to every single person that is hearing this. I'm going to level a challenge to you. The next time in your life you are worried about money, go give some of it away. Look, maybe it's only $5. Maybe it's less than that. Go give it away, and give it away with a smile. I'm telling you, it changes your perspective. It changes your attitude. And it will, and again, I'm not about the universe manifesting things to you. I don't believe that. But what I do believe is that we create our destiny. So my challenge is, and this might be a year or two down the road, but a year or two down the road, if you're sitting there and you're like, oh my gosh, how am I going to survive? How am I going to do this? I want my voice to pop into your head. And I want you to get off your butt and your self-wallowing, go out and go give someone some money to help them out. I promise it will turn everything around.
I just love the psychology behind that too. It makes absolute sense. And it's almost contrarian in a way to where we really don't ever think of that. But the benefits, even though they're not completely obvious, are, again, you just can't measure them. I love it. Unfortunately, let's get away from that for a minute because there are other places where you can put your money that just make a lot of sense to either me or Rob or both. So the next one I had was just simply taking that money out and putting it in the bank. Because the more money you have in your bank account, the more, I guess, at ease you can be sometimes. It's not like the whole, mo money, mo problems, P. Diddy, Mace, joint from like the mid 90s. That's not true. It doesn't have to be that way. If you do some of the things we told you not to do before, well, sure, it can turn into that. But simply having that buffer of having money there, should something go wrong. There's that stat, Rob, to where like 40% of Americans, we're talking Americans, have less than $1,000 in their account should anything ever go wrong, which is horrifying. No wonder people Googled, when are the stimmy checks coming back when they came. It's not a good existence to have. It's not a good place to be, and I've been there. So I always made sure that I was like, all right, I remember these feelings, and it's not like, you hear somebody died or something. It's not that kind of awful feeling. It's this underwriting dull drone of a feeling that just never ever goes away. It's like Chinese water torture almost. Just not having sufficient money should something go south. And so now that I have a bit of money to put in those bank accounts, and that's often what I do, it just makes me feel better. I'm not spending it frivolously. And I don't know, I think that's a great way to go. Instead of investing it in something that might go up and down, just have the cash. What do you think of that?
I think that's a great idea. And the greatest thing about it is, for the first time in my adult life, you can actually earn a decent amount of interest off of your cash. Money markets in the US are paying 4.7% just for money markets. You're not even locking the money up like in a CD. That's just a really, really easy place to put it. It's a really easy, safe place. And for the first time in, again, my adult life, you can actually make some decent money off of interest.
Yeah, if you guys don't know, interest rates were super low for a long time. I do remember the early part of the 2010s. They were higher, but they're certainly not where they are now. So yeah, that's an added benefit I didn't even really consider, even though I knew about it. Just simply the peace of mind of having that cash there, I don't think you can put a price on. Now, speaking of cash, heard this stat the other day, and this is something I should also know, but I didn't know it was this bad. But the spending power of the United States dollar, which compared to a lot of other currencies has been very strong, simply because it's the United States dollar. The spending power of that currency has gone down 25% since 2016. That was not long ago. That was 2 years before I put my channel out. That just doesn't seem like long ago at all. 1/4 of its overall spending power is gone in that short amount of time. So, if you guys listen to my investing podcast, you would already know I am a big proponent of putting that money into gold. Now, you don't have to go to the store and buy it if you don't want to. You can. There are a lot of ways to go about it. I've done videos on this. You can go search for them. But having gold doesn't do anything, and that is the single best part about it. It is a flight to defense. And that gives me a really great peace of mind too, Rob, because while the value of it can go down, it usually goes right back up. It's been on a steady stream upward. And now, knowing what I know about what's been happening to fiat currencies, it's kind of obvious to why. But it just seems like a really smart place to put it. While the whole world is losing their spending power, you can actually relax knowing that at least part of yours isn't. I never really got your take on actual physical gold. Where would you rank that amongst what we've talked about so far?
I will have to rank gold near the bottom. And this is why. Look, I own gold. I think it's great. I think every single person should own gold, and every single person should continuously buy gold through their whole life. So I'm 100% on board with you right there. But when we take a look at gold as an investment, it's not a great investment long term. When we take a look at actual rates of return over 40, 50, 60, 70 years, it's one of the lower performing ones. But as you pointed out, you also don't have the wild swings you get from stuff like stocks and some other asset classes. So it's a very slow vehicle to put your money in. It's a slow, safe vehicle, and it should be a part of every single person's portfolio.
I'm okay with that answer. Yeah. Even though it's not super high. It's higher in my book, I guess, than most people. I'm a huge gold bug in terms of that. Now, the next one I had was, and this is something that people don't always consider, and that is to invest in yourself. Now, what do I mean by that? Well, a few different ways. We're talking about your overall peace of mind here. Would it behoove you to pay somebody to come in and cook for you just not even once a week? Would it be in your best interest to have a personal trainer? Would it be in your best interest just to have a housekeeper that comes in once a week? But the budget just didn't always allow for that. What if it did? What kind of impact would that have on your life? Like, I live in Latin America. Housekeepers are very, very cheap. I always make sure I have the same one come in every Friday. And it's awesome. She actually came down with thyroid cancer, and she was out for a while. And I didn't really want to bring somebody else in because I trusted her. And so I just started to do it myself. Not the same. not the same level of cleanliness, not the same peace of mind. So just little things like that. And not just little ancillary day-to-day stuff like that, but what if you have ever wanted to start a business or invest in a business or become a podcaster or something like that? That does take a little bit of money up front, and maybe that wasn't in the budget either. Maybe now is the time, with this money that you have created from a trading account, to start that up as well. A lot of people never take that first step to what could be a really great thing because they always understand it takes money to make money. One, it takes a lot less now than it did before. But two, even if that amount was out of your budget, now all of a sudden it's not. Now might be the time to take that next step forward in your own personal career that you had never considered before. So, Rob, do you have anything to add to this? And where on our little imaginary chart would you put this?
This is number one. This is absolutely number one. And, when you talk about investing in yourself, I'm really thinking about education. And I'm just thinking to some of our really great traders at Maverick, and they're all hustlers. I just talked to one of our traders. She's awesome. She's doing great. And she's starting all these other businesses out. She's flying all over, going to these conferences and meeting people and starting up these other businesses. All that costs money. All of that costs money to go do, to, attend these conferences, but they're just hustlers. And so I think investing in yourself is the greatest thing you can do.
Love it. And that's something too. Yeah. Up your network as well. It's the corniest saying, your network is your net worth, but it's true. My network was very small because that's kind of how I wanted it. I don't like really dealing with people, but that was foolish on my end. You can go out there and meet very like-minded people that also have a shared interest with what you have, and then things just get better and better and better. Even if you don't have a business, just simply being around those people and gathering ideas really has a plus effect, I think. So good. I'm glad you're with me on that. I didn't even know where I'd really rank that because everybody's different. But yeah, you ranked that number 1. That's awesome. So the last one I had, Rob, and if you ever want to add any more to this, feel free to. But in my investment podcast, I always tell people to look for things that are cheap right now. I don't like buying things unless they're very cheap. I will still add on to those positions when they have gone up in value a bit. But if they're not dirt cheap, I'm just, I'd rather just hang on to the money and wait until they are. And so at any given time, no matter how well things are going, there's always things out there that are very cheap and very unloved. And you're not necessarily speculating on them because they could still be large businesses. Like I'm thinking like mining companies and some of your larger cap cryptos and things like that. Things that are legit. They're here to stay. They're not going to be here today, gone tomorrow. But still, you're doing what rich people do. They don't really come into the market either until things are cheap and unloved. And then they come in while the rest of the world thinks they're crazy. And then lo and behold, they go down in the annals of history as these brilliant investors. You can do that too on a smaller scale. And I'm a big advocate for this. What's your take on it?
Again, we're in total agreement in this episode. I am always looking for what is out of favor. And let me give everyone a little bit of advice. What you don't want to do is you don't want to buy out of favor singular assets. So for example, the car industry was in disarray in 2008. And you wanted to go in and you bought General Motors. Well, guess what? General Motors went bankrupt. That investment went to zero. What you don't want to do is you don't want to invest in a singular investment. What you want to do is invest in groups, in categories. So you made an investment in an automobile ETF. And that automobile ETF, when General Motors went bankrupt, it went down. But it probably only went down 20%. And all the other cars that didn't go bankrupt survived. And then when it all recovered, you still had your money because you invested in the group, not in the individual thing. So again, if you were like, oh, I want to invest in crypto, I would never choose one coin. Find some basket. And if you can't do a basket, if that doesn't exist, then maybe you say, I'm going to split my money up 4 ways and buy these 4 coins to reduce some of my risk. The last one I missed, and again, I'm doing this all the time. I'm always looking for what asset class is out of favor to put extra money. And I know that it's likely going to stay out of favor for another 2 or 3 years. And I've always been like, okay, that one's out of favor. Like biotech right now is so out of favor. It's so out of favor that I'm starting to put money into biotech. It's so hated right now. And the prospects of biotech with higher interest rates are terrible. They're terrible for biotech. But I bought the biotech ETF. I'm going to do dollar cost averaging over the whole next year. And that money is there to stay. But the one I missed, the one I'm still kicking myself in 2019, I saw coal. And there's a coal ETF that invests in mining stocks that do coal. And I remember thinking, coal's done for. Like, come on, we're moving past coal. And all of the, like Europe had to refire up their coal plants because they weren't getting enough energy from Russia anymore. And there was a huge boom in coal. I missed that one. That was the one that I thought, that is so out of favor right now. I just can't invest in it. And it went up like 4x, 5x, 6x. So let's not talk about that too much. So yeah, I love that strategy. Before I turn it over to you, episode is getting very long here. I want to just do one more thing and then I'll shut my mouth. Whatever money you take out of your account, it is absolutely okay to do it if you put it into something that goes up in value. So remember, I said every time you take that money out, I want you to get on a calculator and see how much that's costing you. But if it goes into something that goes up in value, it's a get out of jail free card. You can do it. So what about classic cars? If you love classic cars, if you're a car guy or a car girl, that money can go into a classic car. And as long as you're not an idiot, you buy the wrong one, that money is going to grow still. So think about in your life, what are the things that you do like? What things can you buy that will actually go up in value? Years ago, I've always thought it'd be fun to have a beach house. That's a cool dream. I stay at that beach house 6-7 days a year. And the rest of the year, everyone else stays there and pays me money for it. It's an asset. It's an asset. So just think about what are the things that you like anyway? Let's say you're really into golf. Is there any golf businesses that you could buy 5% into, 10% into, and be part of the golf business? Again, if you're taking money out of your account and it's going into an asset, there's no penalty. There's no reason to doubt that or to second guess that. It's fine. So that's really what I want to end up with, is that if you're thinking where to put this money, think of where can I put it that is fun for me, that is going to give me personal enjoyment, that will at least hold its value or go up in money, or go up in value. That is a really easy decision to make because you're just investing. That's it.
Well, damn, I want to talk about coal some more, but you're right. This is a very long episode, possibly the longest we've ever done. So we'll go, we haven't edited it yet, so we don't know, but we'll go ahead and end it there. I hope this episode was extremely helpful to you. I feel like it is, and like I said before, things like this are so much more impactful than some of the minutiae that people worry about when it comes to trading. So again, if you're here and you made it all the way through, congratulations. You're one of the few people out there who actually get it. Please apply this knowledge where you can, and please join us next week for the Trading Psychology Podcast. Rob and I will both see you next week.
Goodbye, everybody. And remember, next time you're stressed about money, go give some away. It's going to help.